Welcome to Halal Money Matters, sponsored by Sterling Capital. I'm Monem Salam. And today's episode is kind of like a continuation of things we've been talking about in the past, like a three-part series, if you want to call it. It was on, nonprofits. The initial one was about just basically like the 5 pillars of a nonprofit's financial strategy. The second one got into creation of and running endowment. And now with Motasem Benothman, we're going to be talking about how to create a lasting endowment. Motasem is a founder of Portola Springs Capital. It's a crypto investment fund, but also he runs Investment Endowment Advisors, specializing in helping nonprofit organizations build endowments. He's a co-founder there. He's graduated with an MBA from UCLA, and he's served on multiple different nonprofits, from Taiba Foundation to New Horizons, and also the one we're talking about, which is the Islamic Endowment Advisors. I'm really excited to have him here. Let's get started. Assalamu alaikum, Motasem. How are you doing? This is like the second time we've had you on the show.
Wa alaikum salam. Yes, it is. Thank you. It's nice to see you again.
Yeah, it's great. Do you want to just give a quick maybe a background of what you've been up to since we last talked, which was, I think you were one of our very, very early episodes when we talked about Bitcoin and cryptocurrency and those type of things. So is there anything you want to catch up us on what you've been up to?
Yeah, I guess, so one, I'm still running Portola Springs Capital, which is a cryptocurrency investment fund. And then on the side, with some free time, I've now, along with 2 other co-founders, started Islamic Endowment Advisory, which is a nonprofit that helps basically consult Muslim organizations in America to form and govern their endowments. So there's been a lot of activity.
So tell me about this this Islamic Endowment Advisory. Like what made you start it? What was you kind of the idea behind it?
Yeah, the main idea is that if the Islamic organizations in America are kind of far behind the other religious organizations in America in regards to having endowments. We did some analysis using some IRS Form 990s that were filed, and it seems like Muslim organizations are in the low single-digit percentage-wise in terms of having an endowment, and you compare that to churches at around 34-35%. So that's almost a 10x increase. So that signals a problem. And then on top of that, it seems anecdotally there were kind of recurring stories that we hear about endowments that Muslim organizations have where they face challenges mostly rooted in governance issues. And so we wanted to kind of basically build something to help these organizations establish things properly from a governance standpoint.
That's great. And I think I've told you, but I'll just kind of remind everybody who's listening. This is like it's our third in a 33-part series on endowments. What we started off with was just say generally nonprofits. What we started off with was talking a little bit about like the 5 basics or 5 pillars of finance within a nonprofit. And then one of the ones one of the ones we got the most feedback on, and also the more deeper dive, was on endowment. And we had a second session about how to actually set one up. And now we're getting into actually how do we manage it from that phase. So talk to me a little bit about, if you can, the kind of the progression from setting it up to managing, and what kind of maybe what the transition from, and what kind of things we should the boards and stuff should be looking out for and not stumbling along the way when they're beginning to manage the money.
Yeah. So first, before I dive into the transition, I guess I'll say a larger problem with organizations is just kind of getting off zero, right?
Mm-hmm.
So just setting it up, period. And I think one comment I'll add to that is one of the problems that I think one of the problems tied to this is that when you're working, let's say you're on the board or a staff of a nonprofit organization, long-term to you usually means 3 to 5 years, right? Like when you're building a strategic plan or looking at long-term financial planning, 5 years is kind of the max window you're looking at. And with an endowment, you're thinking perpetuity, you're thinking multi-generational, and that requires a totally different mindset. So for most people working at organizations or working for them, 3 to 5 years, it's easy to kind of just focus on the financial strains that you're facing currently, and putting money aside is just kind of hard to do. So it requires setting aside some separate time and really thinking of things from a long-term perspective to help get off zero and build the endowment. Once you're there, in terms of transitioning to managing it, that requires basically a different set of skills, right? The founding or forming of it is more about long-term vision and leadership and getting consensus in the organization. But once you've decided to do so and you now want to manage it, now you want to make sure you have a team that basically has skills around asset management, governance, and so forth to properly manage that money. So that requires basically a committee. So an investment committee, I'll refer to it in this conversation as an endowment committee. So it's important for an organization to build this committee and seek talent with diverse skill sets that fit into this committee to help manage based on different asset classes and decision making with investing, and perhaps even overseeing asset managers or whatever it may be.
So let's talk about that a little bit. I mean, because that starts off with the governance aspect of it as well. So how do you go about selecting a manager or trustee? What should the board of the organization be looking for? Should it be an elected position? Is it appointed? For how long? All of those things.
So I guess there's two things. There's the a potential asset manager, and then there's the oversight, which is the endowment committee, right?
Which could be the same if you wanted to, or you're recommending not, right?
Correct. So I think regardless, you should have an endowment committee. That's in all cases. The asset manager, I think, only makes sense after you've achieved a certain size of AUM or certain size of your endowment, just because they charge fees, and there's also kind of bang for the buck that you get out of that relationship that requires some size. So I think for selecting the endowment committee, that's more finding people in your community or that are, have care about your organization, that have skills either in equities, real estate, commodities, fixed income, just broader asset allocations, maybe PE or VC, general investing, risk management, all these different types of things. And you want diversity in not only skill set, but also in opinions, right? You don't want everyone to be thinking the same way. You want there to be dialogue in these meetings so that ideas can be challenged. We also don't want kind of one person that just kind of leads everything, and if that person likes a particular type of investment, that the rest of the committee is just kind of yes men or women that just kind of follow that. In terms of the asset manager, if you achieve a size to where it makes sense to outsource the execution, so typically the endowment committee is going to define like an asset allocation basically definition. So we want 60 to 80% in equities, for example, and X range in real estate, and so on and so forth. And then the asset manager will come towards the execution and recommend specific vehicles, such as the Saturna vehicles, to apply in each of these categories. And then there's dialogue back and forth and tweaking that.
Right. I mean, one of the things that you mentioned earlier, was the idea that, what I've seen a lot of times is the people that are on the investment committee or the for the endowments or for masajid, they're successful obviously in their career. Some of them are in investments, but they have a particular tilt towards either real estate or private equity or investments in the stock market, those type of things. And what ends up happening is that they become the if you look at the committee of any masajid, and you look at, this guy's a private equity, most likely their investments are all going to be in private equity. Or if you look at real estate, then most likely all their investments are going to be real estate. And it doesn't speak to the balance that you're talking about, to have both, all different kind of asset classes that are represented, especially when it comes to small amounts of money. As you're so slowly beginning, you might not only have, let's say, 50 to maybe hundreds of thousands of dollars. And does it really make sense to have a complete diversification of every single asset class that's out there? What do you think?
Right. So I think your explanation is spot on, in that we do tend to have one person that carries too much influence in these decisions. And that creates significant bias, if not conflict of interest in some cases. So you do want to challenge that. And then in terms of the diversification, so this is where kind of the size of the endowment matters, right? So if you look on one end of the spectrum, you have like the large university endowments and kind of wanting to learn from them as the arguably ideal model from a asset allocation perspective. The problem there is they have large allocations to PE, private equity, and venture capital, things like that. And those vehicles simply are, if you have a $100,000 endowment, you simply cannot allocate to those vehicles. You can't get access to them. You can't even meet their minimums and so on and so forth. So as the endowment is small, and I would say usually about 100K kind of is what I would think of as a entry point from an endowment standpoint. Then you're going to be heavy in equities, right? Just because it's hard to diversify. You can have a little in real estate, a little in commodities, maybe a little in sukuk, but you're going to be very heavy in equities. And then as that endowment grows, then you're able to kind of expand and go into some other vehicles, such as perhaps private real estate vehicles. And as the bigger you get, the more your options are, and that helps basically mature the asset class
But
and
doesn't have
diversification.
you had, is there like a best practice that you've seen where, after a certain asset level, you're like, you know what, I think now we're ready to have an advisor come in and help us to manage this money? Is there like a cutoff point that you've seen that works really well for organizations?
So it's very subjective, of course. Our general thought is kind of when you're in the $1 million range, that's where kind of having an RIA or other type of asset manager may make sense to at least start really considering. And it does kind of depend on what asset allocation you seek, and also what your anticipated growth of the endowment is, not only from investment growth, but in terms of new capital that comes in. And then also it depends on the skill sets you have in your endowment committee, right? So if you're unsuccessful in building a very talented endowment committee, then perhaps getting an asset manager should be done even earlier than that. So there are some variables that factor in, but just kind of roughly $1 million is what I would say is
Okay.
kind of went to.
And a lot of times, because these are nonprofits, they're really run on volunteers and stuff like that. What do you think about the roles, the segregation of the roles between, let's say, the investment committee and those that are out there seeking the money for the endowment, those type of things? Can they be the same? Should they be the same? Or really should they, really should keep them separate?
You're talking from a development fundraising
Yeah, so
standpoint?
for example, is nobody, what'll happen is that, oh, you guys are, this four group of people are in charge of the endowment. Well, they're gonna also be in charge of raising the money. They're gonna be in charge of investments of the money, reporting of the money, all of those things, which sometimes becomes too much for people, right? So I'm not sure if you've had that experience or not.
Yeah, I think they should be separate. I think usually the fundraising should be managed by the organization's development staff, and that does create an extra burden for that staff because they already have an annual fund that they're worried about, maybe a capital campaign. So adding an endowment component to that could spread them a little thin. But I think it's still, they have the skill sets, they have the relationships, they have the tools. So it makes sense to keep it in their forte. And then separately, it also makes sense for the endowment committee to be focused on skill sets related to investing and not worried about the fundraising and piece of things.
Yeah, I want to circle back to the idea of, you talked about it. It's the endowment is something that's in perpetuity, so it's a really really long term kind of mindset you have to have when you're making these investments. But at the same time, it's more a matter of like, so if that's the case, one could argue that because it's in perpetuity, why don't we just invest it in the most aggressive type of investment? Because even if it goes down, you have time on your side, you're adding more money to it, and it's going to be lasting forever. So even in the early stages, what do you say about like the return profile or the risk profile? But secondly, what I've noticed a lot of younger endowments do is really, 1 or 2 years they have really good performance, and that they're touting that performance to be able to raise money. For me, that's not a good strategy. That's the performance on a short term 1 year 2 year basis. Either it's a hit or miss. It's much more long term. So what do you think about that aspect of really trying to promote the investment return rather than just kind of the idea of building the endowment for the long term?
Yeah, I think so. When you're managing money based on perpetuity, it affords some luxuries that influence investing decisions. One would be there's a high tolerance for illiquidity, right? So investing in things like private funds, whether it's venture capital, private equity, real estate, if those funds are locked up for 10 years, for example, that's not a problem for an endowment, right? For you personally, maybe that's an issue, and so naturally in the market, what happens is there's a basically an illiquidity premium that applies, right? So something, let's say something is worth $100, but because it's illiquid, it's trading on the market for $95. So the endowment is therefore able to invest at that $95 price for a $100 value by taking advantage of that illiquidity premium. Additionally, there's a tolerance with the perpetual model for volatility, right? It's okay for things to basically have some cyclical performance because you're focused on a much longer time frame. Whereas if you needed the cash, if you needed to do significant withdrawals within the next year or two, then that volatility can be very painful and you can't make certain investment choices. However, that volatility does not mean you can afford high risk, right? That the volatility and risk are very different. And another thing to think through is when you have an endowment has an asset allocation, ideally you are rebalancing as the value of each of those allocations goes outside the boundaries of what you've defined, right? So let's say you invest 70% into equities and then stocks have gone down, so now it's 60%. So now you do a rebalance and you basically buy more stocks so that you're back up to the 70%. So effectively what you're doing is buying low and selling high, and that helps from a mean reversion standpoint for long-term investing.
And also, as you're raising, as the development department is raising the money, I mean, you could be coming in at different levels, and maybe you're it's almost like your 401k, right? You have the actual allocation that you've made based on the market's movements, and then every month that you're putting in it's how much of each asset class you're putting it into. So I might have a 70-30 mix of every time new money comes in, I'm going to split it up 70-30, but my actual portfolio could be 71-29 or 75-25, and then you're back adjusting it once a year basis and saying, okay, what does it look like now? How do I want to change it? Those type of things, right? Which brings up a good point about this. I'm sure if you're familiar with an investment policy statement, maybe we can talk a little bit about how important that is for an organization, even if it's a small one, how important it is to be able to create an IPS, or is that something that maybe can come later on down the road when the endowment gets bigger?
Yeah, we think that's a hugely important piece, and is actually the kind of like final deliverable for the Islamic Endowment Advisory consultations. So we start with our consulting to start talking through and decision making around all the components that eventually make their way into the IPS. So that's an important part of governance, and I think any endowment has to have an IPS, and I immediately question kind of like the governance of an organization and their endowment if they do not have an IPS.
So tell us a little bit more about the IPS. What does it have in it? What can you leave out of it? What's your recommendation?
Yeah, so one would be about the spending policy, right? So when are distributions made, and what is the size of those distributions, right? And this conversation is really an important one to kind of validate whether the organization is thinking long term or not, because sometimes people are establishing endowments and they're already getting excited about what distribution will be made next year, right? And that's okay if you're starting off with a good size, healthy endowment, but usually you're starting off with a smaller endowment and planning to grow it over the years. So in that scenario, you ideally want to delay those first distributions as much as possible. So what we've done is with our clients, we basically have built out like a spreadsheet model that will forecast out for the next 40 or so years what you input data such as what is your operating budget, what is your anticipated growth of that operating budget, what's your anticipated growth, what's the current amount of the endowment, anticipated growth of the endowment, and then you basically put in variables of what the distribution is. With generally it's 3 to 5%, with probably 4% being most common, and then when that distribution begins, right? And what you'll find is that by just pushing off that distribution for 10, 15 years, you can see material compounding benefits, right? So there's usually that dialogue with the organization of can you afford to basically delay that as long as possible, and then establishing that parameter.
But Motasem,
Then
the IPS also has more than just the spending part, right? Does it also have embedded like, okay, this is going to be the asset allocation, those type of things? But then also from that, how often can you change it? Is it something that's I'm assuming it's not a permanent document that you can't change. So how often should that be revisited and those things?
So generally the IPS is basically approved by the board, and then it gets handed over to the endowment committee as basically their guardrails, right? These are the rules that the endowment committee can play within. The idea is to build that IPS so that it doesn't need to be changed for many years. Eventually, things will change just because markets change. So an example would be even just by the AUM, by the assets of the endowment growing, now all of a sudden maybe you can afford to have private equity or venture capital investing. So you may have started off with the IPS saying 0% to 5% for PE VC, and then now all of a sudden you're at X million of dollars, and you can now allocate a higher percentage. So then the endowment committee goes back to the board and says, we propose that you make these changes to the IPS, and then the board votes on that and then sends it back. So the idea is you want to ossify the IPS as much as possible, because you don't want material investment changes to happen just based on market dynamics, right? Like the Iran war or things like that. You don't want people just reacting on the short term, right? You build a asset allocation that is intended to be long term and intended to survive different macro conditions, right? Whether it's recessionary, inflationary, whatever. You build it to kind of endure those, and then you make modifications, I don't know, every 5 years or so, based just on a need basis, but it's not something that's intended to be done frequently.
Yeah, that's a good point about like having that separation of who's actually creating the IPS and then who's actually using that IPS to be able to make decisions and those type of things. So which is really great. So and then what other components would be in the IPS?
Another example would be Sharia compliance, right? Defining what that means for your organization. A common one we share with organizations is the AOFI standards. So some organizations may have something more unique. So regardless, whatever they decide, it should be documented in the IPS, because then that forms the investment restrictions for the endowment committee and or the asset manager.
Do you feel is enough in the IPS to say we're only going to make investments in those investments that have a Sharia board, or is it because if you get into this idea of has to be AOFI, it might get more restrictive as far as your choices of investments are concerned. So how do you kind of balance that between having your own kind of set of standards versus saying, you know what, where the standards are that as long as they have an approved Sharia board that audits it as the investment company, then they're okay being able to do that.
Yeah, it's a very subjective decision there. It really depends on kind of the culture of the boards or the organization, and also their kind of the strictness or the level of adherence that they care about, both for them as well as the donors. So that's very much individual case basis.
Okay, and then now if we can talk a little bit more about like just the reporting aspect of it, like when and just like every other human being, but they'll be touting it if the returns are really good, but also then maybe kind of just hiding a little bit of the returns if they're really bad. So how often should there be some financial reporting going on to the board, obviously, but then also eventually to the donors and the beneficiaries? Is that the responsibility of the investment committee or the board? Those type of things.
Yeah, so for the endowment committee should be meeting quarterly and reviewing performance, right? So they're overseeing the investment decisions that have been made and or possibly overseeing the asset manager if there is one. Then the endowment committee should be passing along reporting to the board at least once a year. And you could do more if appropriate for your organization. It depends on the board's kind of how astute they are in terms of investing and things like that. And then as far as donors go, that's a little that's also very unique to one that's very unique to the organization and the donors themselves. So reporting even something as simple as the size of the endowments, there are some donors may see that as a great thing and hey, now I want to donate more. Others may see it as hey, you have a lot of money, I don't need to give you anymore, right? And so an organization needs to kind of they're going to have the best feel for their donor base or their member base and determine from that, like, okay, what level of transparency makes the most sense for my audience. What I see most often is that endowment details are kept within the organization, but then shared individually or on a need-to-know basis with donors when it comes up, or if they request, probably a little more proactively with larger donors, especially if you're trying to raise money from an endowment for the endowments, then more transparency happens during those campaigns. So it definitely, there's a lot of variance in that depending on the community or
What are
the
your
organization.
thoughts about promoting the rate of return? What investments are in that? Is that really something that it should be? Should that be public information, or should that be kind of, well, as you mentioned, one-on-one with a donor, or just basically tighten it within the board?
Yeah, so I generally would encourage only share when needed. Don't volunteer extra information just because it's it's very easy to find community members that are very subjective to say, oh, well, why are you doing that? Or,
Yeah.
okay, you got 8%, I got 10%. Why are you underperforming? Or why I don't like this particular vehicle you've invested in. This doesn't make sense because, AI is gonna, everything should be in AI or nothing should be in AI. There's always gonna be someone
Yeah.
arguing, and you don't want to get into those detailed discussions that, no one wins with those conversations. And another thing, by the way, as just a tangent here, when you're thinking through performance, so you have to look at expected returns and then inflation and then fees. And then all those components. So you basically take expected return. So let's say you're assuming 8% returns, right? And then if you have an asset manager, they're going to have a certain fee structure. If you don't, that's a zero. But then there's inflation. So whether that's 2 to 3%. So now your 8% is 5%. And if you're distributing 5% as your spending policy, now you're basically breaking even, right? So your endowment is never actually growing unless you happen to be fundraising for it and adding to it. So this is where it goes into the calculus of when to make distributions, how much effort to put into raising more money, and the types of the asset classes you're investing in, right? So inflation is kind of like this hidden factor that needs to be kept in mind as your numbers kind of look attractive to you, and you think you're netting out positive, but you may not be.
Oof. So I want to go back to one point, which is the quarterly part of it. I mean, when an endowment is small, I mean, is it still important to do the quarterly, or are you just saying that now as you're small to be able to build good habits for the long run about doing that? I mean, is it really important to have quarterly meetings? Because as you mentioned, small organization with small endowments means a small amount of manpower that can actually do the work. So what are your thoughts?
Yeah, I think so. I'm on the boards of an organization that recently launched. I'm on the endowment committee, board and the endowment committee for an organization that recently launched a smaller endowment. And we had the endowment committee had a first long meeting to discuss asset allocation, and we all agreed upon. And part of that conversation was also this pool of money we have. How quickly do we deploy it to, right? But then then we talked about, all right, let's meet again in 3 months. And a comment was made in the meeting of like, okay, I'm not sure we're going to have anything to discuss then, which is a fair point, right? I think what'll likely happen is in the first 1 or 2 meetings after this one that we had, there will probably be some discussion on potential tweaks, like maybe, some of us may be researching other vehicles and or learn more information, such as I had a meeting with your participation funds manager, right? And so I learned more about that. So, but at some point, with the current size, it is likely that we will just decide to skip certain quarterly meetings, right? So whether it be every other one or whatever it may be, and that's okay. But the idea is to kind of put it in the calendar or have that reminder set. And then if you decide to skip it because there's nothing new or material, that's okay.
And then also just now we're talking about the organizational structure and transparency. Is the IPS where you actually handle conflicts of interest, or is that something that's done outside? And what I mean by that is, maybe you're an advisor in the local community, and then you happen to be on the endowment committee, and now you're the one advising the board from the fiduciary level. So, how do you kind of frame conflicts of interest, and where does that policy lie? Is it within the IPS or somewhere else?
Yeah. So the policy of conflict of interest will be defined in the IPS. However, what's more important is the behavior, right, of leadership. That means leadership at the board level as well as leadership of the committee level. Just because, so conflict of interest, I think, is an area that our community has a weakness in, and it's especially sensitive and prevalent when it comes to managing assets, right? So, and a common example is organization is now is trying to build their endowment committee. So they think who in their community has basically experience managing money, right? And RIAs, asset manager, those are the first people that come to mind. Now, if that RIA is seeking to earn that mosque or organization as their clients, there's a conflict of interest there if they become part of the endowment committee, right? So you want to make sure that any participants in the committee or board signs an annual conflict of interest letter so that it's clearly written out what they're agreeing to, and then also stipulate what their conflicts may be. And two, just in terms of how you manage the meetings and discussions, it's important to basically not allow certain things to transpire, right? So if a person it's easiest to avoid problems if you address them up front, such as if you're trying to recruit an asset manager to the committee, you tell them up front, look, we will not be able to sign with you for business. Unless there's some way where you can waive the fees or something like that. But if there's a financial benefit to you, we cannot basically also have you as a decision maker, right? So that's when there's a potential conflict of interest up front. If there's a conflict that arises later on, so let's say, for example, 2 years into an endowment, you now want to pursue a product and a member of the committee happens to have a fund for that product. At that point, you need to kind of work with that person to assess that either they step down from the committee or they find a way to still pitch their product without financial benefit to them or something else. But the point is, you don't want to get into a point to where people are kind of pressured to pick something that is beneficial to a member, that may not be the best decision for the organization. And it also puts the organization at risk because there are basically some rules from a nonprofit standpoint that you basically have to report some transactions that would be benefiting the decision makers. So there's a lot that goes into it, and our community, unfortunately, is very prone to this. So you have to be very diligent to avoid that.
I really appreciate that. That's some great advice. Well, now let's kind of step back a little bit, and I know you have a lot of experience on not only on the boards of endowments, but also just advising them and those type of things. Can you share maybe let's say the top 3 mistakes you've seen like young Islamic organizations make when it comes to managing their endowment? Maybe 1 or 2. Maybe not 3.
Yeah, no, so I think the biggest mistake is tapping into the principal, right? So this is where kind of the whole quasi endowment thing happens. A very common anecdote is a masjid either gets a large donation or has a surplus, and now they have, $150,000 in the bank, and they say 100 of that is now their endowment, right? But it's very unofficial. And then what happens is 6 months later, the masjid bathroom needs a remodel, and it needs 75,000, so they tap into that 100, right? That is not an endowment. That it needs to be very clear, both explicitly as well as culturally, that once assets are in the endowment, that principle is to never be touched, like never. And that's something that there needs to be strong consensus on, so that the current people basically adhere to that, but then also needs to be documented via IPS and some other things, so that future staff and future board members and committee members also recognize
So
that.
let me stop here for a second. So let's talk about this for just for a minute. So, if you get to a point, and I know this, inshallah, never happens to a masjid or an organization, but sometimes you have these organizations that begin to struggle, right? And so they're having a tough time, maybe making payroll, or growing it, or fixing the bathrooms, those type of things. And so now you have this endowments for the long term, but the organization might not even be around for the long term if they don't fix whatever's going on. So have you seen any kind of best practices? Like, for example, can you borrow from the endowment and then eventually pay back, or is it like, do you say, okay, forget it, we're in survival mode, it's triage, we're just gonna take it from the endowment and just use it because we might not even be around if we don't? Is there any anecdotal stuff you have on that end?
I don't have direct experience with those types of situations. However, the endowment should not be seen as a crutch in these circumstances, right? So an example would be when we're advising clients on endowments, we're recommending that before they even consider the endowment, they have a certain runway in terms of reserve funds, right? Because you need to be ready for a rainy day, or every organization is going to have financial constraints and so forth. So you have that. You also need to factor in kind of like how sustainable is your fundraising, also how flexible are your operating costs, right? So if you end up having a very bad fundraising year, are you able to reduce staff or reduce other expenses and things like that? So these are all factors into like how much your reserve, how big your reserve should be, and then the endowment needs to be on top of that, right? So the general idea is, in a scenario of a financial crunch, the endowment is not considered as an option, right? It's not. So borrowing from it should really not be a something that's discussed. Obviously, if you're at the point where like you're literally about to shut the door, then arguably everything's on the table, but like it shouldn't mean. Thing is, like, most organizations are almost always facing some kind of financial constraints, and you never want the endowment to be thought of. This is actually one of the advantages of having the endowment managed by the committee and not by the board, because the board is always discussing like, okay, how are we going to cover this 100K shortfall, whatever, and then you can't have item 2 on the agenda of, hey, we just got 100K in returns in the endowment or whatever. So it's too hard to switch hats like that. So having separate meetings and separate people for the endowments is healthy in that sense. But organizations, alhamdulillah, find a way, and but the endowment is not. Arguably, the endowment should help make things easier, in that when you talk to people for this emergency situation and you're asking the community for Qard Hassan loans or whatever it may be, knowing that there's an endowment should give them a little more comfort that there's some sustainability with the organization, and it's just a temporary thing that they need to resolve.
Any other common mistakes that you can think of that that come up?
Yeah, another would be just the timelines are not long enough, right? Going back to kind of the perspective of thinking, 5 years versus 100 years and so on. So it's important for people to think multi-generationally for the endowment, and that changes some of the decision making. And then lastly is what we covered already, is conflicts of interest. That's just a really pervasive problem that really needs to be managed well.
That's great. No, those are really great ones. And then the other one, let's kind of talk about more big picture. I think globally, you do have like a fairly large amount of money, and we're talking hundreds of billions of dollars in different type of awqaf or endowments that are there, whether it be Malaysia or any other Muslim country that's there, right? So there's two questions that I have, right? Number one is that over the years, the endowment structure in these Muslim countries has become stale. Meaning that, it's not really growing a lot. It's basically, there's no professional management, those type of things. So we talked a little bit about how to prevent that from happening, which is basically having the IPS and good governance and those types of things. But the second thing is, I know we're a very young community, but how do you feel, because you're in the space, how do you feel we can get to scale is when it comes to endowments? When is it going to be that the masajid or the organizations have a large enough endowment that not only is that endowment being invested, but also you can take some of that endowment and use it for the operational part of the organization to be able to function?
Yeah. I would say it's probably two things that will happen to enable this. One is as our organizations transition from being managed by first generation into second and third generation Muslim Americans. And I don't mean this negatively towards first generations. They obviously built foundations for us and under incredible circumstances. And alhamdulillah, we're here today due to their initiatives. But now kind of like to try to take things to the next level. I think second and third generation American Muslims are going to be more likely to think through some long-term initiatives such as endowments, and I think that's going to help significantly. Part of it is because they're going to be looking more at other organizations, non-Muslim organizations in America, and see kind of some of those differences. The other thing I think that's going to help, that will likely be an organic thing, is the wealth distribution in our community. I would argue originally, like when most of our masajids were built, the community was made up mostly of like doctors and engineers, so just a lot of like middle income Muslims. And what that meant was a lot of the donation money was pretty well distributed across the community, okay, which is a great thing. But what it also means is that the donors themselves had little voice, because let's say, as an example, everyone's giving a $5,000 or $10,000 check. Now with kind of the startup worlds and whatnot, we have a lot more Muslim Americans that have founded large startups and done exits and whatever. So basically, there's a growing wealth disparity within our community, and normally that conversation is viewed as a negative. But in this context, I actually think it's going to be a positive, because our organizations are going to be supported by fewer very large donors. And those donors are going to have more say and influence on the organization, and they thus will be able to leverage that money to force growth in the organization.
That's an interesting
right?
point. I never thought of it that way, but you're right. I mean, it's almost like saying, look, there's a tidal wave of money that's coming through, right? Because of the intergenerational wealth transfer and that type of thing. So, I guess it's up to the organization to say, look, if we want to take advantage of that, we're basically going to be competing for governance, for, endowment structures and those type of things. And then, because like you said, if a person is like, okay, if I'm going to be donating, I just got my IPO'd, I'm like my company IPO'd, I'm going to give $10 million. They're obviously going to be wanting to go to an organization that already has the right structure in place, rather than trying to create a structure just so the money that could come in. So it's really trying to say that, okay, Mr. Nonprofit or nonprofit organization, get ahead of this wave and really have your ducks in order so that you're ready to be able to take that money coming in.
That's absolutely correct.
Yeah, that's
right?
that's
And then
that's a good point.
hopefully those large donors will be able to kind of see the gaps or areas for improvement for the organization and create restrictions that basically force that to be resolved, right? So like when I was at New Horizon Irvine Islamic School, we had a very large donor that basically said, yes, I will make a large contribution to your organization, but one, it needs to be matched. So that forced us to really step our game in terms of development. But two, he said, half of my money needs to go to the endowment. And that made an incredible difference for us to actually get off zero from the endowment. It created incredible momentum where we got a lot more money separate from him into the endowments as well. And alhamdulillah, like now it's in a significantly greater place thanks to that vision, basically. I think overall in our community, we're alhamdulillah, we're all very generous, but we tend to not leverage our donations and not make them restricted, which is what the organization wants, but sometimes it's better for the organization to actually restrict it and force behavior.
And then also, just as we're kind of coming to a close, one question I did have for you is, you have a masjid that probably was built, let's say 10 years ago, 15, 20 years ago, and there's just starting on the path of the endowment. You're like, well, okay, we have a donation, 100,000. But the land value of that masjid is huge, right? They probably bought it for, let's say, $1 million, and now it's worth maybe much more than that, especially where you live in California or where I live in Washington. Should a masjid actually consider land value of the masjid and endowment as well to be able to say, well, I have a much bigger, not for the sale of it, obviously you don't want to sell that property, but more from the breadth of, thinking to yourself, wow, actually I have a bigger endowment than I thought I did because of the fact that there's value in the actual masjid itself?
Yeah, it's a debatable question.
Yeah.
There isn't a firm answer to that. What we advise is if the property is income generating, which usually means if it's a property that you are not using for your own operations, then yes, count that as the endowment. But the property that you are actually using, like the masjid itself, for example, then no, do not count that as part of the endowment.
Great.
But what you can do though is if you're creating a separate entity, then you can merge them together in terms of like asset protection for that entity, right? So you have one entity as the masjid or whatever the organization is, a separate entity that holds the property and the endowment. So those assets are protected from the operations of the organization. So even though that property is not considered part of the endowments, it can be part of that same entity.
Right. Yeah. Well, listen, thank you so much. I wanted to just kind of leave you, just ask you one question, which is, how do people get a hold of you? How do they take advantage of the services that Islamic Endowment Agency is providing? Those type of things. I think would be great for people to be able to reach out to you directly as well. So.
Yeah, sure. Thank you. So our website is Islamic Endowment Advisors .org, and our email address is info@IslamicEndowmentAdvisors.org. So yeah, we're happy to speak to any organization that's looking to create their endowment or needs assistance with their existing endowment.
And you have capacity to do more, I guess. I'm assuming. Thank you.
We have capacity. Okay. It is just a team of 3, so depending on influx, that capacity is limited. But we are also it's basically a no charge engagement. We're not financially benefiting from this. We just want to improve our organizations.
No, it's great. Thank you so much for not only doing this for the Muslim community, but also coming on the show and kind of explaining exactly what are the best practices, and how people do take advantage of the service that you have, because you have a wealth of knowledge between you and the other team members as well. So thank you very much for your time.
Alhamdulillah, and thank you to Saturna for having Sharia compliant products and for this podcast series.
Awesome. Thank you.
All right. Assalamu alaikum.
Thank you for listening to Halal Money Matters. If you like what you hear, please do rate us on the app stores and also leave us a review. It helps other people find us a lot easier.
The thoughts and opinions expressed on Halal Money Matters do not necessarily reflect the views of Saturna Capital, Amana Mutual Funds, or their affiliates. This podcast is prepared based on information Saturna Capital deems reliable. However, Saturna Capital does not warrant the accuracy or completeness of the information. We do not provide tax, accounting, or legal advice to our clients, and all investors are advised to consult with their tax, accounting, or legal advisors regarding any potential investment. Investors should not assume that investments in the securities and/or sectors described were or will be profitable. Investors should consult with a financial advisor prior to making an investment decision. The views and information discussed in this commentary are at a specific point in time, are subject to change, and may not reflect the views of the firm as a whole. All material presented in this publication, unless specifically indicated otherwise, is under copyright to Saturna. No part of this publication may be altered in any way, copied, or distributed without the prior express written permission of Saturna Capital. Performance data quoted herein represents past performance and is no guarantee of future results. Investment return and principal value of an investment will fluctuate so that an investor's shares, when redeemed, may be worth more or less than their original cost. Current performance may be significantly higher or lower than data quoted herein. Performance current to the most recent month end can be obtained by visiting www.amanafunds.com or by calling toll-free 1-800-728-8762. Please consider an investment's objectives, risks, charges, and expenses carefully before investing. To obtain this and other important information, which you should carefully consider before investing, about the Amana funds in a free prospectus or summary prospectus, please visit www.amanafunds.com or call 1-800-728-8762. The Amana funds limit the securities they purchase to those consistent with Islamic principles. This limits opportunities and may affect performance. The Amana funds are distributed by Saturna Brokerage Services, member FINRA/SIPC, and a wholly owned subsidiary of Saturna Capital, investment advisor to the Amana funds.